So we're ready to get into some of the meat here of this toolkit. Now, a lot of you guys may have heard about technical indicators before. And as I said already today, technical indicators work really well in the Forex market, better than they work in any other market, in my opinion, because we don't have gaps in price action. These indicators use math formulas to paint on the chart. A moving average paints as a beautiful line going across your chart. Where do you think that line is coming from? It's gathering price action information, putting it into a formula that gives it a current price, and that line keeps calculating as that price moves, and then the line moves in accordance to that. So people will say all the time, why do you need indicators? The two reasons. Number one, they're meant to smooth out the data that price is giving us. And number two, they help us focus on what is most important relative to price and relative to volume. People will also say, why do you use indicators if they are lagging behind price action? Well, my answer is, I don't really need an indicator. I don't think any of us do. We don't need indicators to forecast what's coming. Remember, the outcomes of trades, the future price action movement is never guaranteed. So we're not looking for an indicator to tell us what's coming in the future. Follow me? We're looking for an indicator to tell us what's happened in the past so we can react based on that, not forecast based on some bias or some fundamental idea. These indicators give us a really great idea of trend, and when you use the indicators correctly, you're going to be able to use them to help you time your entry signals. Now, right off the jump, understand we are not trading, 8 and 21 moving average cross, we're taking a trade. No. We're going to use these moving averages to confirm or deny trend, and that'll be one step of our overall analysis, one step of the checklist. The indicators that I use that we're going to focus on here, 3 of them, and they're all available for you. I'll put links down in the description of this video in Kajabi so you guys can click and put them on your chart. I'll even put a YouTube video in the bottom here, down below me, so you can go watch me adding these to my chart. But if you go to indicators, you see I have them favorited right here. We have the ASFX ADR, average daily range. We have the ASFX EMAs and Asian range and AR, and we have the ASFX TDI. So let's first talk about the Asian range. This is one of the easiest indicators to understand, and I think that it's really beneficial if you know how to identify the Asian range, because if you can identify it, it'll help you identify which pairs are potentially going to be choppy today. And no one wants to get stuck in a sideways trade. We don't make money in sideways movement. We make money in pairs that are moving, either in trend or counter trend. So how do we identify the Asian range? It's really simple. I only got 2 bullet points, as you can see. This is the first 8 hours of the day, and like I said, it's used to identify consolidation or accumulation. So here's a chart with the black candles like I told you we would use. You guys know that this vertical line right here, that's the period separator, so that starts the day. So what we're looking at here is a box around the first 8 hours of the day. This is part of the ASFX EMA and Asian range indicator. The ASFX, it's ASFX EMA plus Asian range. AR is Asian range. It puts a horizontal line at the Asia high and a horizontal line at the Asia low, and it kind of shades in the background. You don't need the background shaded in. As you see more of my charts, I only have the high and low marked. And why it's important is because if we were to, let's just say, see a pair trading within that Asia high all day, we wouldn't want to jump in a trade of something that is still trading within that initial high and initial low set during the Asian session of today. We want to trade something like this that breaks out of the Asian range, maybe comes back and uses that Asian range as support and trades off of it like that. That's how we want to use the Asian range, to qualify pairs that are already ready to move, not to trade something that's moving sideways. So if you see a trade idea, make sure, one of the things that's on the ASFX checklist that you're going to learn later is, are we in the Asian range or are we out of the Asian range? And in this example, we are out of the Asian range. The way that we define that is one candle body on the 15-minute chart breaking above the Asia high pin or Asia low pin, pin being the highest price. Whenever you're measuring price to a high or low, you never use the bodies, you only use the pins. But when we're drawing trend lines and things like that, as you're going to see, we do use bodies more than pins. So that's how we measure the Asian range. Now, we're going to come back to that a lot. We'll talk about it and bring it full circle. But let's move on to the moving averages, specifically the exponential moving averages. So you probably are going to see people write MAs all the time. MAs, moving averages. These are EMAs, exponential moving averages. And basically, the reason we use these is because they weigh current price data more heavily than older price data. And as a short-term day trader, I don't care about what it did 2 weeks ago or a week ago or 3 days ago. I want to know what it's doing right now. So EMAs, in my opinion, and in a lot of professional traders' opinions, you'll see are a much better choice for the active trader. So let's break down which EMAs I'm using. First, you're going to see a yellow line on the chart. This is our quickest moving average. It's an 8-period moving average. The reason you call it a period is because what it's doing is looking back at the last 8 candles on whatever time frame you're looking at, and it's gathering the data over the last 8 candles to paint where the line currently is. And as the line moves, it moves because price action moves, it's gathering new data and weighing it heavier. So we have the 8 in yellow, then we have the red 21. So 8 and 21 moving averages, those are our short-term moving averages. Then we're going to add in 3 more. A light blue line here, that's the 50. A white line here, that's the 200. And then a dark blue line up there, that's the 800. So we have the 8 and 21, those are the short term. The 50 is like a medium term moving average, the blue, light blue line right here. The 200 and the 800 are more of our higher time frame, longer time frame moving averages. So some people will say, Austin, why do we need all 5? The reason is because all 5 on my chart here on the 15-minute chart give us an idea for what trend is across multiple time frames. I don't have to go looking at the 1 hour, the 2 hour, the 4 hour, the daily, the weekly. I don't have to do any of that. If I can find clean trend here on this 15-minute chart, which I'm going to show you how to do here in a few minutes, if we can find clean trend, I know on the higher time frames, if these are in line, that my EMAs are telling me the higher time frame trend is either short or, in this case, it's short, or long if you're looking for buys. So before we go into that too much, I want you to see, if you were to double click on the indicator on TradingView once it's on your chart, you'll see this box pop up where you can adjust your Asian range high or low. You can adjust the fill of your Asian range right here, but then you can change the color and the thickness of all the moving averages right there as well. So when you double click the color, you can change the opacity, or you can even change the line thickness right here. So it's really up to you. I like to keep them pretty thin and not too bright because once I see it, I don't need it to be popping out of my face, distracting me with color. So I try to turn them down a little bit and keep them pretty thin. That's how we set up the EMAs and the Asian range. It's all in one indicator for you that makes it super easy. Now we'll get into my favorite indicator, the Trader's Dynamic Index. This is the TDI. You know what they say about the TDI? TDI don't lie. There's 3 components of the TDI. You have a 21-period RSI, so that means it's gathering data from the last 21 periods. You have a 34-period moving average, not an exponential moving average, just a regular moving average, and then a 7-period moving average. Those are the 3 lines that you're going to see in the next photo on the TDI. The RSI is in green. Write this down if you need it. The 34-period moving average is in yellow, and the 7 is in red. The moving averages gather their data from price action. This TDI gathers its information from volume. So the reason we use both, as you'll see here in this chart, this is what my chart always looks like. The reason we use both is because it gives us confluence or it denies us a full trend. Here's what I'm saying. If the moving averages are all moving down, but the TDI is giving us bullish signs that it wants to move higher, we call that divergence. That's not in full trend. But if the EMAs and price action are moving down and TDI is also short biased, and I'm going to teach you how to read that, then we know both of those together give us confluence of trend. That's a trend that we can count on as a higher probability trend versus something that isn't not in agreement between price action and volume. So it's really important that you don't just use moving averages, because if you were to just do that, you're not getting information from volume, nothing to confirm or deny your idea. That's why a lot of people that use moving averages never find consistency. But if you also combine it with this TDI, or really, you could probably do it with any volume indicator, you're going to dramatically increase the percentage of wins and the probability of your trades with both indicators versus just one. So to break down the TDI a little bit more, we have this yellow line here. That is that 34-period moving average. That is what we call the market sentiment line. You'll hear me call it market sentiment. You'll hear me call it the L50, the liquid 50. The reason why it's liquid is, as you can see, it moves. Here it started lower, then it comes higher. That is our liquid 50. Going across the screen right here at the 50 value, it's kind of faint, so you can't see it that well, but it's there. You'll see it when you add this to your chart. The 50 value in the middle, We call that the stationary 50. The stationary 50 versus the liquid 50. You follow me? Stationary 50 because this is built into the RSI. You can't move that line, but the liquid 50 can move above it and below it and above it and below it, and that can give us an idea of market sentiment. What market sentiment means is who is in control, buyers or sellers. So when we look to read trend, if market sentiment is holding under the 50 value, we're going to believe that sellers are in control. And backtesting tells us that's the case. If market sentiment is holding above the 50 value, that would be when buyers are in control. Now, if market sentiment is sitting in the middle, which it's not in this example, it's moving from the sellers in control to the buyers in control. But if it was sitting in the middle here, we would call that reset, accumulation, consolidation. That's a really good thing to use in combination with that Asian range to identify which pairs might not be a great idea to trade today, which pairs might be a little choppy today. That's identifiable with this market sentiment line on the TDI. The green line that you see, that's a relative strength index. That's called an RSI. And the red line that you see, we call that the trend line. The red line is probably the least important, but it still holds value. As we get into the starter pack, you'll see how that plays into our entry signal. But for just trend analysis, really focus on the yellow market sentiment line. That's what we're going to talk about. And I mentioned this already, but it's important to understand these are gathering information from different sources. You have your EMAs and your TDI. Together, one is gathering data from price, the other is gathering data from volume. Together, we're going to confirm or deny the trend idea for each day. Average daily range can be added up this way. Now, I made up this formula. It might not make sense to you guys, but maybe for some of you it will. N is the distance from the high price of the day to the low price of the day, and 1 is how many days ago. So if you add up the high to the low from the last 5 days, that would give you X. X divided by 5 is the average daily range over the last 5 days. So how does that look on a chart? You can see I have these green lines. That's our indicator. They paint each day. Remember, here's that vertical line separating the day. Here's ADR. Here's ADR. Now, the lines will move higher or lower depending on where price moves, if it's moving up or if it's moving down. So these green lines are movable. They move on their own. That's what the indicator does for you. How we know when average daily range is maxed out is when it's touched both ends of the green line, both the top and the bottom. So if you were to look back here, let's just call this Monday. This is Monday. By Monday, 9 o'clock, this already maxed out its average daily range. And it actually goes lower than that. It moves more than it does on an average day here in this example. That's not typical. What we like to see, or what we like to assume, I should say, is that it will be a typical day, as it was here on Tuesday, the next day, trading within that average daily range, not breaking above it or below it. And that's what you see here. Each day will have a number there as well. That number is the number of pips that it has in distance over an average day. So if you think about it, ADR here is 60. So if ADR, average daily range, is 60, what we would say is, okay, let's say we're finding a trade here. We want to buy it here. Stop loss is 10 pips. We only got 20 pips to ADR. That means if I'm risking 10 on an average day, because ADR is only 20 pips away, I could get 2 to 1 still on this trade. So that still could be a good trade that we take. Let's say, for example, you were looking to sell this here the day before. If you were looking to sell this, it's already close to, if not already maxed out, average daily range. So any trade setup that happens, once it's already reached its average daily range, you're already decreasing the probabilities of that setup working. Logically, just think about that, right? If it's already done in terms of distance, if it's already moved what it does on an average day, why would you look to trade it? Because you're aggressive, because you're greedy. You don't need to do that. So this indicator can help you avoid trades that are already done for the day. Go find a different pair. Go check a different pair. See if you can find a better setup. This one, in this example I'm saying, is not perfect. It could be a lot better. And you don't want to get stuck assuming that it's an above average day, when in reality, it just might not be. It might be an average day. And then you can't get good risk reward. And then you're in a trade that's going sideways, and nobody needs that. We're trying to get you into money-making trades, not sideways chop trades that make you hate trading. So now you should understand the most important technical indicators: the Asian range, the EMAs, the TDI, and average daily range. Those 4 indicators will make you an ASFX trader. Now that we're starting to piece this whole puzzle together, when we get down to the trigger signals and the management of each trade, you'll see how all 4 of those are used in the ASFX trader checklist. So now I want to move into how to read risk reward.